Today, we will talk about Canadian taxes for beginners understanding Canadian taxes. Canada's taxes are as abundant as our lakes. There are taxes on consumption, such as sales tax, land transfer tax, liquor tax, gas tax, and customs tariffs on imported goods. Then there are taxes on assets, such as property taxes and car stickers. And finally, there's a tax on income. Here's what you need to know. What is income tax? For almost every dollar you earn, you must pay a portion in taxes. It wasn't always this way. Before World War I, Canada was a tax-free haven. Unlike England and the United States, Canada prided itself on its no federal taxes policy and used it to attract desperately needed skilled immigrants, investors, and capitalists. Instead, the government made money mostly by selling off natural resources and charging high custom fees on imported goods. But in 1917, Finance Minister Sir Thomas White implemented the Income Tax Act to pay for World War I and asked that it should be reviewed after the war. Canada has had an income tax ever since. While income tax may seem natural and inevitable to us today, it was met with resistance at the time and considered a significant burden. When income taxes were first introduced in 1917, single people had a personal exemption of $29,757 in today's dollars, while married people had an exemption of $59,514. Over those amounts, they were taxed at just 4%. Now married and single people have identical federal personal exemptions at around $13,230. The top federal tax rate is 33%, and when we add in provincial tax rates, the total marginal tax rate now reaches 54%. But we pay it without much complaint because it's the price of living in a prosperous nation. As Oliver Wendell Holmes, the 19th century U.S. Supreme Court Justice, said, "I hate paying taxes, but I love the civilization they give me." The Canadian Revenue Agency, CRA, collects this money to pay for the government's operating expenses and delivery of services. Taxes are the reason we have the military, the police force, libraries, high schools, hospitals, roads, prisons, and the CDC. The government redistributes much of these taxes to low-income families and vulnerable Canadians in the form of child benefits, employment insurance, old age security, and social assistance. How income tax works in Canada. You're required to report your income to the CRA annually by filing paperwork known as a tax return. In this return, you must list all your income sources and note your eligibility for a tax deduction or tax credit. The tax system is based on trust. Although the CRA does know about some of your income, they mostly rely on citizens to self-report their total income accurately. The CRA recommends you file a return even if you do not earn any money. If you don't file your taxes, you may miss out on free money. Some payouts you may be eligible for include Child Tax Benefit, GST/HST Credit, Guaranteed Income Supplement, the deadline to pay your income taxes. The deadline to pay taxes, for those who earn enough to do so, can be confusing because the date you must pay does not always line up with the date that you must file. Employed individuals have the same payment and file date, April 30. If this falls on a weekend, the tax deadline is the next business day. That's because their taxes usually get taken off at the source on each paycheck, so their tax calculation is simpler. Self-employed individuals must pay any taxes owed in a tax year by April 30, but they have until June 15th to file their return. The CRA charges a fee for late filers, 5% of your balance owed plus an additional 1% for each month late, to a maximum of 12 months. Income tax rates in Canada. Canada has a graduated or progressive tax system, which means the more you earn, the more you pay. Under this system, money is divided into income brackets, which determine the applicable tax rate. A common mistake is to assume that all income is charged at the rate of its highest tax bracket. In fact, we are charged progressively, which means that first, you pay the rate in the lowest bracket and only pay the higher rate on each additional dollar. This is also called your marginal tax rate. For example, if you earn $1, you'll pay 10%, but on the second dollar, you'll have to pay 20%, and on the third dollar, you'll be on the hook for 30%, but you never have to pay 30% of $3. Instead, you paid a total of just $0.60, which works out to an average tax rate of just 20%. Some find this graduated system fair, while others believe it burdens hard workers, penalizes success, and discourages prosperity. Corporations are the exception to this system, however. They pay a flat tax instead of a graduated tax. The corporate income tax, a flat tax for small, private Canadian corporations, for example, maxes out at 15%, 9% federal income tax rate, plus up to an additional 6% provincially, no matter how much they earn. Graduated tax rates can be confusing because the income tax brackets don't depend just on the amount earned. They also depend on where the money comes from. Plus, each province has a completely different tax bracket. You must add the two together to come up with the total rate. Some Canadians are surprised to learn that not all income is treated equally. The government typically gives a tax break to money earned from selling an investment. 50% of the capital gains are taxed at the marginal tax rate, which applies to their taxable income. And to encourage jobs and development, small Canadian corporations have extremely low tax rates. The highest tax rates are the personal income tax rates applied to wages and salaries. The CRA differentiates between these 6 types of income sources: other income, including employment and interest; capital gains; eligible dividends from large, public Canadian corporations; ineligible dividends from small Canadian corporations; general corporate income; small business corporate income. For example, let's say you made $50,000 in employment income, and you live in Ontario. That's in the second tax bracket, both federally and provincially. The federal government charges you 15% on the first $49,020 you made, minus the federal exemption of $13,808, and then 20.5% on the remaining amount. Ontario charges 5.05% on the first $45,142, minus the provincial exemption of $10,880, and 9.15% on the remaining amount. That's what we mean when we say that the more you make, the more you pay. Dividend money is considered to have already done its duty since it comes from after-tax corporate profit. Instead, you might also be eligible to receive a dividend tax credit, which is a non-refundable tax credit meant to offset the effect of double taxing. What do you think of our video? Let me know in the comment section below.